You may have heard ROI on many occasions. It stands for return on investment. In real estate, it measures how much profit you make compared to how much you've spent. The formula for calculating ROI is to use net profit divided by total investment. Let's look at the numerator net profit first. Net profit equals total revenue minus total expense. The total revenue is the monthly rental income multiplied with 12. Total expense takes a bit more time to calculate because it includes multiple types of expenses. The major ones are property tax, HOA fees, and maintenance. Let me show you how you can find the relevant information on Zillow. First, search for the property by entering the city and state you are interested in investing in, or you can enter a zip code if you know it. Second, consider your budget. For this demo, I want to only see the properties under $450,000. Third, filter out any home type you don't want to see. For example, I am not interested in lots or land. Once you click enter, you should see the properties that match your search criteria. Let's say we want to take a look at the one priced at $310,000, since it's the least expensive. Even though not always accurate, Zillow provides an estimated monthly rental income based on a property's physical traits, comparable local rentals, also known as comps, and public data. You can multiply this number with 12 months to get the total revenue. Now let's search for property tax. Look for a public tax history section for the amount from the most recent year. Please note this amount is for the entire year, not for a quarter or a month. If the property you're looking for is a condo or an apartment, you will need to find out the monthly HOA. Scroll up to the top to locate this number. Now you have the tax and HOA. The last major component of the total expense is the maintenance fee. The rule of thumb for calculating this fee is 1% of the property's value. However, because the property we searched for is an apartment, some costs are covered by the HOA fee. We can reduce this to 0.5%. Once we get the total income and total expenses, we can subtract the total expense from the total income to achieve the net profit. ROI isn't one size fits all. It depends on the market you're in. For most rental investors, the sweet spot is between 6 and 10%. That's your standard benchmark. Now, if you're in a high cost of living area, don't panic if your ROI looks lower, because the real payoff is often in long-term property appreciation. On the flip side, in lower cost markets, investors usually expect more cash flow. That's where an ROI above 10% is considered a really strong investment. When you're evaluating ROI, don't get caught off guard by hidden pitfalls. One of the biggest mistakes investors make is underestimating fees and taxes. And here's the kicker. HOA fees almost never stays flat. They creep up year after year, thanks to rising maintenance costs and inflation. Plus, in some cases, you might face special assessments. Those surprise charges are used to cover major building improvements, such as a new roof or elevator repairs. If you don't factor these in, your ROI could look great on paper and shrink fast in reality. Property taxes are directly tied to your home's value. So when property value rise, your tax bill usually rises right along with them. But that's not the only factor. Local governments also rely on property taxes to fund public services, things like schools, libraries, and road repairs. And sometimes they'll add what's called a special assessment. It's basically an extra cost to cover big projects like building a new school or upgrading infrastructure. If you don't plan for those, your tax costs could sneak up on you fast. Here is another hidden trap in rental investing: vacancy. Even the best property won't be rented 100% of the time, and ignoring that can make your ROI look way better than reality. So when you are calculating ROI, do not just assume 12 months of rents. If the property is in the best location or the market is still warming up, you should factor in vacancy of 1 to 2 months. And notice how ROI comes down to 3.43%. Besides the major fees and tax we just covered, there are other potential costs to your investment. If you're not able to make a cash offer, you would have to obtain a mortgage. Mortgage interest is the cost of borrowing money to buy a home. It's calculated as a percentage of your loan balance, and it affects how much you pay each month. Early payments mostly go towards interest, but over time, more of your payment reduces the principal. We'll have another session to expand on this topic. For now, just remember it's a burden on your ROI. The other cost is landlord insurance. It's designed to protect rental property owners from financial loss due to property damage, liability claims, or lost rental income. Unlike homeowner insurance, it's specifically designed for non-owner occupied properties and is essential for anyone renting out a home or apartment. So here's the bottom line. ROI isn't just a number, it's the compass that guides your rental property decisions. Whether you're in a high-cost city like me, chasing appreciation, or in a low-cost market focused on cash flow, knowing your ROI helps you separate a smart investment from a risky gamble. Remember to factor in taxes, maintenance, and vacancy because your real ROI is not what you collect, it's what you keep. If this breakdown helps you see rental property ROI more clearly, hit that like button, subscribe for more real estate insight, and drop a comment with your own ROI goals and experiences. Let's keep learning together how to make our money work smarter, not harder. Bye! See you next time!